Looking for a low-risk, low-maintenance way to start investing? Index funds might just be the easiest path to financial success. Stick around to learn how you can benefit from the stock market's growth with minimal effort. Investing can be complicated, but not all investment options require you to constantly monitor the markets or make difficult choices. That's where index funds come in. Index funds are one of the most beginner-friendly, passive ways to invest, allowing you to capture the market's long-term growth with a simple and effective strategy. What are index funds? Let's break it down. Index funds are a type of mutual fund designed to track the performance of a specific market index, like the S&P 500 or the Nasdaq. What does that mean? Instead of picking individual stocks, index funds invest in all the companies in a specific index. For example, if you invest in an S&P 500 index fund, you're investing in all 500 of the largest companies in the United States. So, how does that help you? By spreading your investment across hundreds or even thousands of companies, index funds provide automatic diversification. This reduces the risk that comes with trying to pick individual stocks. And because they're passively managed, meaning there's no one actively picking which stocks to buy or sell, index funds have lower fees than actively managed funds. Historical performance of index funds. Index funds have a proven track record. Over the last 30 years, the S&P 500, which is the benchmark index for many index funds, has returned an average of around 10% annually. This is without needing to constantly adjust your investments. While there are years when the market will go down, over the long term, the market has historically gone up. This makes index funds a great option for investors looking to grow their wealth steadily over time. The power of compounding and long-term growth. One of the biggest advantages of index funds is the power of compounding. When you invest, not only do you earn returns on your initial investment, but you also earn returns on your returns. For example, if you invest $1,000 and earn 10% in a year, you'll have $1,100. The next year, you earn 10% again, but now it's on $1,100, not just your original $1,000. Over time, this compounding effect can turn even small, consistent investments into substantial wealth. Index funds versus actively managed funds. Some investors prefer actively managed funds, where a fund manager picks stocks with the goal of outperforming the market. But here's the catch. The majority of actively managed funds fail to beat the market over the long term. This means you're often paying higher fees for lower returns. Index funds, on the other hand, are designed to match the market's performance, and with lower fees, they often outperform actively managed funds in the long run. Why index funds are great for beginners? Are you new to investing? Index funds are a great starting point because they're simple. You don't need to spend time researching individual stocks or constantly monitor the market. Once you invest in an index fund, you can essentially set it and forget it. This makes them perfect for people with busy lives or those who are just starting to learn about the stock market. And because index funds are diversified, they help protect you from the risks that come with investing in a handful of individual stocks. How to get started with index funds. So, how do you get started with index funds? It's easier than you think. Here are a few simple steps. Choose a brokerage. To invest in index funds, you'll need to open an account with a brokerage. Companies like Vanguard, Fidelity, and Schwab offer a wide range of low-cost index funds. Pick an index fund. Look for an index fund that tracks a broad market index, like the S&P 500 or the total stock market. These funds give you exposure to a wide variety of companies, which helps spread your risk. Set up automatic investments. One of the best ways to build wealth over time is to set up automatic monthly contributions to your index fund. Even small amounts, when invested consistently, can grow significantly over time. Stay the course. Markets will go up and down, but the key to successful index fund investing is to stay the course. Resist the urge to sell during market downturns. Remember, index funds are for long-term growth. Benefits of low fees. Another reason index funds are so popular is their low fees. Actively managed funds often charge high fees for the work of picking stocks, but index funds require much less management. This translates into lower costs for you as an investor. Over time, these small fee differences can add up to tens of thousands of dollars in savings, allowing more of your money to stay invested and grow. Common index funds to consider. There are many index funds to choose from, but here are a few of the most popular options. 1. Vanguard S&P 500 ETF, VU. This fund tracks the S&P 500, which includes the 500 largest U.S. companies. 2. Vanguard Total Stock Market Index Fund, FZROX. This fund gives you exposure to the entire U.S. stock market, including large, medium, and small companies. 3. Fidelity Zero Total Market Index Fund, FZROX. This is a low-cost option with zero expense ratio, making it a great choice for new investors looking to keep costs down. Want to dive deeper into how to pick the right index funds? Like and subscribe to WealthWave, and stay tuned for our detailed guide in upcoming videos.